All right, all right. What's up, guys? This is like my fourth time trying to make this video for you guys. One time they're putting in a new window in my house, being loud. Second time it didn't save. Third time my neighbor's yelling at me through the window about my dog. It's been a pretty eventful day, but hopefully this time it saves. I can't do it on the Mac. Mac, it's just not saving. I don't know what's going on, so we're gonna do it. Went back to the office. We're just gonna do it here. And so we're just going to talk about the large cap exhaustion gap short. It's a mean reversion play. Basically, what you want to see on the daily chart is a stock deviating off the 8 EMA, 15-minute 200 EMA. Essentially, those are going to be your price targets. That's mean reversion. Now, there's a structure that you want to see on the daily chart. Ideally, you want to see some type of breakout on high R vol, meaning volume, a continuation day. Not that means no red green trapping days. Very clean move, and then the exhaustion gap. Now, this might sound like a bunch of what are you talking about, but we're gonna get into it. I'm gonna show you plenty of examples. I'm gonna show you a few other things that you could also bring into a concept that you could bring into to small caps as well. So ideally, this is for over billion market cap with 100 million float, 200 million float, high float names where you're not getting huge moves, right? Not 300%, 200% like a low float, low market cap type of name. This is going to be different. So extension and what you could expect from the move before the potential predictable pullback to the mean is going to be different than a low float where 300% is pretty normal. 300 plus, 200% plus. These might be NVDA, very, very big market cap, very big float. You might not expect that at all. Well, you won't, it's just not going to happen. So you could expect a 10% move on NVIDIA to be an extension. You could indicate that by the daily EMA. SMMT, you could expect a little bigger of a move because it's only TIGR because it's only $1 billion market cap, but it's still considered larger in my book. Um, so I'm going to show you how you could play these and things like that, and by the end you'll have a full understanding how to do this. Now for this, you add into winners on this, but I've been playing them for a very long time, so therefore I would recommend when you first start that you don't do adding into winner at the beginning. I would recommend to prove concept and consistency by hitting one entry, one exit, and then learn the structure of the intraday chart and the nuances of once it goes red, should stay red. You could add. Once it fades and hits back red, you could add again because it should close weak. Swing it to the following day to the 8. There's so many different things you have to learn. So therefore, I would not, first of all, size up on them yet. But these are easy money plays. And when you have an easy money playbook, I have 6 easy money type of plays. You don't have to trade all that random bullshit. You don't even have to trade gapping traps. You just wait, come here. You can come here 8 times a month and make 100,000, and do nothing. And you might not believe me, but you can. You don't need a lot to make money. In fact, when you have less, it's easier to make money because you can narrow your focus just to not perfect, but to master those few setups. So this is SMMT. And look, like I said, you want to see the breakout, continuation, exhaustion gap, right? Deviate off the 8. Well, this is not doing that, right? Red, green trap, red, green trap. Now you have this consolidation day, very tight range. Breaks out. Continuation day, exhaustion gap. And that's what you want to see. Deviated off the 8. We had a 50% move, but reason being is because on SMMT, you'll see here that we have a 14 billion market cap with 100 million float. Therefore, extension is going to be that's great extension for that name. You got to learn this as you go. What's considered extension for specific fundamentals? For this is really good. And it's deviating off the 8, meaning it's overextending. It's going up very fast, heating up. And now you get that exhaustion day. Breakout, continuation day, exhaustion gap on volume. And then how do you trade it? So we'll go to 916, go to 917. I want to show you how you could trade it 2 times. Well, I traded it. I'll show you my chart after this. You want to look for squeezes. You don't want to short weakness on large caps. Ideally, you want to look for some type of euphoric type of squeeze and fail. Even if it opened weak, consolidated, you want it to squeeze out and then fail. So what I do is I wait for it to squeeze, fail VWAP, short when it failed VWAP, risk high day, and then I'll add into the winner. Cover at the 15 and or the 8. Not perfect, and then the 8. Right? So there's another way of getting into this too. Once it fails, it's now the first red day as well, right? Green, first red day. You could short into a pop, right? Expecting that it should fail red. It might go over a little bit and then fail, and then you could ride it down. Usually they will either make new lower days after 12 o'clock or retest the bottom of the range. If they close weak, likelihood is they're going to fail. Gap down the following day for continuation down to what? The 8 EMA on the daily. There's many different ways to trade. If you miss the initial trade, there might be another opportunity to get in later on. Or if you cover some of the weakness, you could add back, move the risk down, cover more, and hold some overnight. That. So that's SMMT. I did not trade that as perfect as how I'm talking about it, but you can. So shorted when the breakdown of view up, let it squeeze out, failed, risk high day, added into the winner. Right. That's what it is. Ideally, you're looking for that exhaustion gap after the breakout continuation day, and then you want to let it squeeze out on that exhaustion day, break view up, shorten the view up, risk high day, and then add into. Now we're gonna do TIGR as of recent. Now let's look. TIGR 1 billion float. 1 billion market cap, 150 million float. Right. Well, the other one went. We're not going to expect 100% move. I mean, 80, 60s. I mean, those are great moves, right? For that float, but you're not going to know that until you either back test this, or you just really. I would recommend just get experience. You don't have to back test that. You could, but really just get experience. Trial by fire. Anyway, just know the structure, know the concept, right? Understand the idea, right? Consolidation, breakout on volume, continuation day, exhaustion gap. Where'd it go? You could have held overnight as well on the exhaustion gap day, and it would have gapped down. The nice one, gapped down into the 8 EMA. So what did I do? I let it squeeze out, right? I don't want to short weakness. I let it squeeze out, short under view up, risk high day, and add it into the winner. Right? Then, if you cover some down here, say, when it pops up again, you could expect that it's going to stay red. It's short more. Expect it to retest lows or break lows. And if it closes weak, it should gap down and potentially go near or even hit the 8 EMA on the daily. Very simple. I mean, this is what you want to trade, the things where you're not second guessing yourself. And the better playbook you have with the more easy money trades, the more often you trade. But I don't think gap and craps technically are easy money. I think they're actually very difficult trades if you're not reactive, especially if you don't have good discipline. It's not going to be profitable. Okay, so NVDA was so this is my TIGR trade. I had a little bit of an impulsive entry here into weakness, and I knew right away. Went from irrational to rational. Hold up, get out, wait for my entry. I did that. I should have held some overnight. I should have covered some here. I should have added some back up in here. Covered more here. Held overnight. That's hindsight. But yes, if you learn the structure of these trades, you could 100% do it. Right? I could always trade better. Right? There's always things I need to improve. So NVIDIA was, I put these, there's a bunch of them, but NVIDIA and SMCI I put specifically because these will never leave my mind. These are the biggest growth stocks currently. Not SMCI, I don't believe anymore, but NVIDIA is. And they just had so much potential. They're so liquid and things like that. So this is I mean, this is huge, huge market cap, huge float. So I'm not going to expect a big move. Look, 10, 20% move would be insane. 20% might be wide, right? In the video, this was this day here, and you're going to see this often. Not all the time, but when you do it, you should be aware and you should execute on these easy money trades. You're doing yourself a disservice not doing that, in my opinion. So, oh, here we go again. Here we go. Give me a second. We're gonna finesse this real quick. Finessed it. All right. Or it starts tweaking. So here starts extending off the 8 EMA. That's the extension tool. The 8 EMA is an indicator of what? Extension, mean reversion. Going far off the trend, we should have a predictable pullback. So now we have this breakout day right here. We have this consolidation period, breakout day, continuation, huge gap. Right? This is about a 10% move. But for that market cap, that is extension. For that float, extension. Specifically the market cap. So how do we trade it? Well, let it squeeze out. Like I said, you want it to squeeze out. Do not force a trade. If you miss one, you miss one. More times than not, a lot more times than not, they will squeeze out. So let it squeeze, fail view up, short. Or you can short right here. Wherever. It's no perfection. Risk high a day. Right? Then you could add into the winner. Right? And this one just went to the 8 EMA intraday. More times than not, 8 EMA is a swing target. But there are outliers in the market where they will hit swing targets intraday. It's not often, but they do. SMCI. So this is my video trade. I could have did way better on this trade. 6,000. You can see how I shorted it, failed. I got impulsive again. Always happens, but it's all right. I manage it. No perfection. Got in there, got in, added, covered some. I hit the bounce because remember what I said. It should close weak, gap down if it's not at the 8 EMA, or make new lows. So I hit the bounce, covered near the lows. I should have swung some potentially, or just held some because it did make new lows later on in the day, and it went to the 8. So patience, very important. But that was a great trade. Now we have SMCI. I don't have the chart for SMCI. My trade, I just don't know where it is, but 27 billion market cap, 500 million float. You're gonna expect what, 40, 50% move? I know this because I've experienced it. This is stuff you gotta hold up. This stuff you gotta work on and learn. This is SMCI. These things just don't wanna. Things just wanna be a pain in the ass. Second. So this is SMCI. All right. You can see here, guys. Same thing, right? I mean, it's that easy. Sometimes it should be it should be that easy. The hard part is really just making the right decision. Patient. Breakout, continuation, Q4 gap. All right, deviating off the 8. Big move. This specific fundamental stock. Don't short weakness. Don't short weakness. Wait for the squeeze out, shorten the view out, and then you can add into the winner if you figure out how to do so for time. All right. That's literally it. Now you have these indicators to provide extension. You know the pattern on the daily. You should understand the fundamentals of each stock. You want volume, and want to squeeze out the gate. You don't want a short weakness. You want it to squeeze and break down view up, and then you can add into that. That's really it. I might have missed some things, but if you have any questions, feel free to hit me up in the room, whatever you want. Take care.